Let's discuss some examples of current assets. Current assets refer to short-term assets which are owned by the firm for a maturity of less than a year. Let's think about it. What does a firm own for less than a year? Some examples are cash, inventory, which includes things such as raw materials, finished goods, or things that are a work in progress, which refer to unfinished goods. Other examples of current assets include accounts receivables. As an example, let's assume we have a company that sells laptops and the company sold the laptop to a customer named Mark on credit. Because he paid on credit, Mark will pay the price of the laptop of $1,000 in the future. From the company's perspective, the company will receive this amount of $1,000 or this account in the future. Therefore, we call it accounts receivables. Essentially, it is when a company sells a product on credit and it will receive the money in the future at some point of time. One other example of a current asset includes marketable securities. To explain what they are, let's assume a company has an excess of cash. It's not wise to keep it in a safe because there's no return from interest if you were to save it in the bank, for example. Therefore, a company could put this cash into a short-term deposit at a bank and receive interest on savings. Or it could purchase short-term bonds and receive a coupon payment. Bonds are essentially a type of financial tool where we borrow from the public instead of the bank. We'll explain this concept in detail later. So that is a list of all of our current assets. Now we have our example of current assets. How are we going to order them? In a balance sheet, orders are very vital. We rank our current assets in terms of liquidity, from the most liquid to the least liquid. Liquidity has two characteristics. It is one, ease to convert to cash, which means essentially, can you sell the asset easily? And the second characteristic is speed to convert to cash, which means, can you sell the asset without making a significant loss? An example of this is gold, which is a highly liquid asset because A, we can sell it easily, which satisfies the first criteria of converting it to cash easily, and B, it also satisfies that condition. We sell it at its market price without having to forego any loss, which essentially satisfies the second criteria as well. Another example of a liquid asset is a car. To see how this plays out, let's look at a scenario. Let's assume you decided to migrate to Italy for a new job and you will have to depart tomorrow. What are you going to do with your car today? In this instance, let's say you must sell your car, and because of the timing, you must sell it at a discount because you're migrating, and you do not have time to wait for the best price. Consequently, the car is a less liquid asset because you have to forego the value of the car. Now, we have defined liquidity. Let's order our current assets items from the most liquid to the least liquid asset. First, on our list, we would put cash as it is our most liquid item, as it's already essentially as liquid as it can be. Second would be the marketable securities. And this is because a company can essentially withdraw its deposits or sell bonds, for example, at any point of time without making a significant loss. The third item on our liquidity list would be the accounts receivable, because in order to convince customers to pay earlier, we need to provide them with an incentive of a discount, which means we have to make some sort of loss. And fourth, and the very last item on our list, would be inventory, as the least liquid item. This is because as a firm, we need to manufacture raw materials into final goods. Then we need to communicate with sales and the marketing team to sell the product. And then we also may have to sell it on credit, delaying the period in which we receive the cash.